Welcome back. Still with me in the studio, Alan Wood, Head of Institutional Business at Investment Solutions. We're talking about passive and active investment this evening. An active investor. You've now convinced me that I need to put some of my money into active investment. How do I go about trying to find that person?
Sure, Jeremy, we've
only got
2 seconds.
13 minutes.
13 minutes is a good time. You know, we run a business where we analyze managers, and that's our bread and butter. We do it day in and day out. We spend a lot of time doing it, and some would argue that, you know, the financial services sector has created an environment that makes it just so complicated for the average man on the street to, you know, to try and sift through, you know, all of these issues and try and come up with a solution that works for them. So I guess with that in mind, I would say the first thing you've got to do is, you know, as an individual, unless you have the capability to go out and do research yourself, you should look for a good advisor. So I mean, I think we do need to, you know, make that point up front. You know, advice comes at a cost, and, you know, we're not going to get into debate on the cost-benefit analysis of that. Now, once if you feel that you want to go and analyze active managers yourself, the problem that I think we face is that the only piece of information available to the average man on the street is survey information, and there's lots of, you know, surveys, and, you know, there's lots of information around the best top performing manager over the last year, and you can look at many surveys, and you can look at how managers have performed in the past. The problem is that's just purely looking at the past. So you're making a decision about the future looking at past performance, and that's what typically happens. You know, when you choose a unit trust investment, most of us will go and look at the surveys and pick the best performing one, and that's the one that we want. Yeah. Now the interesting thing is that very often the manager who has underperformed, especially over the last 12 months, is actually the one that you want to be with.
He's the one who's got the rocket.
Yeah.
And he's going, okay,
yeah.
Oh, that's fine. Okay, so I underperformed. I'm going to show all of these other guys, and he's going to be the one running ahead of the pack.
That's right. So if you've got time and if you understand what you're doing, and you don't want to, you know, go and partner with an advisor who can actually look into these issues, then I guess you know, what we do on a daily basis is go and meet the managers. So let's take a manager A, and let's not get into names because otherwise it'll get controversial on the show, but let's call the manager A.
Yeah.
You know, the problem is that when you let's
so you go and sit down with these guys.
We sit down with them,
and you say to them, why are you making the following decisions? What's the basis of it?
Absolutely, that's exactly what we do. So we'll sit down, and the first question I guess you've got to ask yourself is, when you see a good track record, so let's look at a manager with a great track record, a Coronation, for example, and you've got to ask yourself the question, whose track record is it? Is it the person who you're meeting with, or is it the person's predecessors? So have there been any changes in staff over that point in time? So you look at people, and you assess whether there's continuity of people, whether the people who have made those decisions are still around, because there's no point in buying into a fund manager and that person who owns that track record has moved on to another fund manager. So you look at people. The next thing that you would look at is the process they follow, and you'd ask yourself, you know, how do they actually make their decisions? What process do they have? Because did their phenomenal performance, especially if it's short-term performance, come through luck, or has it come through skill? So you can have really great people, but their good decisions are not repeatable. So you would need to look at their process, and then the other two issues you look at is their philosophy, and you try and unpack how it is that they make money. Do they, for example, you know, are they really an active manager? So they don't care about, you know, how they perform in the short term relative to an index or relative to other managers. Do they, you know, have they got a very strong philosophy to, you know, go and buy, you know, contrary to what everybody else is doing in the market? Because typically those managers, you know, they'll give you great outperformance when everybody else is, you know, giving you mediocre outperformance, but when everybody else is giving you mediocre underperformance, they can give you really poor performance. So you would look at that, and you would try and assess, you know, based on all of these factors, whether the manager's performance into the future is going to give you, you know, good performance. And you know, at the end of the day, and you know, at the risk of punting a multi-manager, I would say that most investors actually just don't have the time or the skill to do that work. And there's a strong argument to say that you actually can't put your money with one manager because, and there's plenty of evidence to show you that, for example, Alan Gray have done really, it's a great brand name, phenomenal asset manager. We rate them very highly, good manager, but they do go through periods of underperformance. And the risk that you run in putting your eggs with one manager is that when they underperform, you capitulate and you move away from them to go to last month's or last year's top performer, only to find you're chasing last year's top performance.
Yeah.
So I think you should spread your investments amongst asset managers. I think that's important. And if you don't have the skill to go and find the best managers, then rather delegate it to somebody else.
Yeah. Just out of interest, do you guys, who do you share your information with? Because you go out, you gather all this info.
Yes.
Who do you share it with?
Well, you know, a lot of the information is proprietary. So we do keep a lot of it. A lot of the information is confidential, and we keep it to ourselves. You know, but the reality is that, you know, this information filters into our portfolios, and a large number of our clients, and I'm not talking so much, you know, clients who are, you know, the average man on the street. I'm talking mostly institutional clients, retirement funds. Most of them are asking for insights, and so we do share snippets of information with clients. In some instances, we actually do give advice to clients on which managers to choose, and in those instances, we would share more information with those clients. But by and large, our information is proprietary because you know, that's what we do in our business day to day is go and research the managers and then construct portfolios to, you know. So as much as an asset manager or an equity manager would go and find the best companies in South Africa to invest in, we believe we can find the best asset managers to invest in.
So you then, just to put you in the right perspective here, you guys deal with major corporates or institutions,
yes,
and you would guide them in where they should possibly be placing
absolutely
their money from
yes,
an active investment point of view.
Absolutely, which asset managers to choose. And we would take it a step further, where we would either, if a client said to us, you know, help us choose a manager, we'd love to work with them. If a client said to us, look, we have what we call a very low risk budget or a low governance budget, we actually just don't have the time, skill, or the resources to make those selections ourselves, we want to outsource it 100% or fully to you, then we'd actually make those calls on their behalf. So they'd invest in a portfolio, let's call it an equity portfolio, or a portfolio that has equities, cash, bonds, and other asset classes in it, and we would have a full mandate to pick and choose the right active asset managers in that portfolio.
So they would just specify what sort of risk profile they're looking for.
Yes.
Okay. Having said that, and I know in the first half of the show you said that you don't purport to be an expert on European management and stocks and that, and so forth. How do we, compared to, let's say, European or US or Chinese fund managers, how do South Africans perform?
South Africa has actually performed very well. So, and I'm looking at a 10-year period.
Okay.
And primarily because the crisis in 2008 hit. Let's take US for example. It hit the US far worse than emerging markets. And the interesting point about that comment is that it potentially leads one to conclude, hold on, why don't I put all of my investments then in South Africa? Why do I actually take money offshore? So in answer to your question, Jeremy, South Africa has done very well if you measure over the last 10 years. Over the last year, interestingly enough, developed worlds have generally outperformed emerging markets, and South Africa has lagged.
But isn't that going to be something going forward that we have to look at? Because those developed markets are still making money. The emerging markets are the ones who I would suggest are probably going to only start feeling the Eurozone crisis in the next year or two.
Jeremy, I think the issue is very complex, and I mean, I think, the last thing I'd want to do on your show is pretend I'm an economist and try and unpack these issues. And I think what we try and do often, and as investors, is look to the headline news and try and make investment decisions on that headline news. In my views, that's dangerous. So let's take a company like Nestle, for example. And you know, I hope I'm right. It's probably listed on a European stock market, but it's listed on a developed market stock market, BMW, for example. The reality is that, you know, you can draw the conclusion that because that's a developed market investment, it's a poor investment, because the developed market is going to lag emerging markets, despite, you know, you probably suggesting the opposite earlier. But, you know, I think, you know, most economists would say that growth is going to come out of the emerging markets over the next 5 to 10 years. So you draw the conclusion because of that, that I will not invest in, let's say, BMW, for example. The problem is that BMW might be selling a lot of its cars to emerging market clients who happen to be in China. And so I think, you know, we mustn't be so simplistic to take top-down views of the world and say, look, because the developed market, in particular Europe, is in crisis, let's avoid investing in the European market. You actually have to go and dig into the detail, and you have to ask yourself, where are these companies actually selling their products? Who are they selling them to? And, you know, the world is global now. So just because a company is listed on the London stock market doesn't mean that it's a London or a UK-based company.
I suppose what you're essentially saying is what you were saying earlier about choosing a fund manager, where you say don't put all your eggs in one basket, spread them across different fund managers. It's the same with where you're investing your money.
Yes.
And you don't just go and put it all into one pot and say, right, emerging markets, that's all I'm looking at.
And the danger with doing that, and we see it time and time again, we spoke to clients a year ago when exchange controls were relaxed, and these are institutional clients who could now increase their offshore weighting from 20 to 25%. The problem is that when we spoke to them about a decision that we were taking on their behalf to move to 25%, they looked at the returns on a South African portfolio and they compared that to an international portfolio. And I can't remember the exact numbers, but the numbers were scary. South African portfolio over the last 10 years probably gave you in excess of 12, 13, 15%. US portfolio or an international portfolio in rands gave you 1%. And they said to us, why are you taking more of our money offshore? Sure. The only problem, and a year down the track, you know, we've actually outperformed.
Just based on the exchange rate, a year down the track, you've made money.
Yeah, so I think what you need to do is, you know, and I do think this is where advisors do come into the play. You've got to move, you've got to have a balanced portfolio, you've got to have a mixture of investments in cash, equities and bonds, you've got to have some offshore, some local. Don't try to, you know, bet on what you think is going to be next year's winner. The reality is that very often what you think is going to be next year's winner is based on what was last year's winner. And we tend to, you know, human psychology is such that we look at what happened over the last year and think it's going to continue over the next year.
And nothing ever does.
Nothing ever does.
Alan, thank you very much for your time.
Thank you, Jeremy.
Great talking to you. That's it for this week. We'll catch up with you next week. Hopefully you have a good one. Bye-bye.